Good morning, Marcus. Welcome back to Policy for Normal People. This is our special episode for our listening and viewing audience of Policy for Normal People's monthly market update with Marcus. Marcus, how are you doing today?
Doing great. I'm doing great, Christy. Another lovely Wednesday. How about you?
Yeah, great. Yeah, I had a good Thanksgiving, very quiet. Husband and I just stayed home. We didn't want to fight the traffic nightmares and potential delays or cancellations that a lot of people were seeing in the airlines. So, folks, if you were traveling during the holidays, I hope that you had a smooth transition to and from. So, as I've said in the past, Policy for Normal People is a podcast for we average Americans who come together without the politics to talk about things like the market, which we're going to talk about today. We do a monthly review with my friend here, Marcus Sturdivant Sr. from the ABC Squared. He's a financial advisor and expert on helping Main Street meet Wall Street, which is his fantastic tagline that I love to repeat every time we do this show. And we're going to get into some interesting stuff today. November has again been kind of a topsy-turvy roller coaster ride as far as market activity. We've continued to talk about and read about and hear about, is there an AI bubble? Do we need to be concerned about a market crash or at a minimum a recession? We'll get into those things a little bit. Also talking about the Fed today and possibly on the horizon there and what we saw, especially in November. So hope you'll enjoy the show, and feel free to visit my YouTube channel at Policy for Normal People under my name, Christy Amata. My consulting firm, Amata Development Services, is a marketing, communications, and fundraising consultancy helping businesses and nonprofits nationwide that sponsors this show. So without further ado, Marcus, at the ABC Squared, you offer financial literacy to your clients. So before we dive into, policy intersection with what happened in November, I want to give you an opportunity to tell our listeners and viewers a little bit about your business.
Oh, okay. Sure. Yeah. So just a little bit about my business. It's an RIA firm down here in North Carolina. We help folks with financial planning, financial advising. I know it's a bad word, but holistic financial planning. We take a look from the whole beginning to the end of your plan. So it's not just investments. We like to look at everything and create a plan for people at different stages in life. So that's pretty much what we do. And as far as financial literacy goes, that's a passion that I have, obviously. It's incorporated in my process. And when I work with folks, we want to educate them as much so they can make informed decisions as well. Like all the decisions won't just be made by me. We want to work together, grow our clients and people just in general through information and education and financial literacy.
That's fantastic. And I applaud you for that, Marcus, because as you and I have talked even off camera, I think one of the things I lament as a Gen Xer is that my generation and those before it didn't benefit from financial literacy really being part of school curriculums growing up. I think that curriculums could improve on that. So I applaud you for making that a special niche part of your practice. So my first question for you this morning, Marcus, is do we have a tale of two economies? We went through a 43-day government shutdown. We're missing the BLS numbers from October. And we see reporting of persistent inflation, rising prices, depending upon, what buckets we're looking at, of course. And then this, what I'll call a specter of a possible AI bubble in terms of, we're still in a bullish market, but, is it sustainable? So with all of that, are we looking at a tale of two economies?
It's one economy in a K shape, right? So it's like kind of like the upper and the lower. And when I say upper lower, that just means like earning or percentage of wealth that people hold. And yes, it definitely appears that the pressures have been focused on the lower earners here pretty much this entire year, with the higher earners holding up the economy. It appears they seem to be spending more. They are trading down. Some of them, they used to go to Target, now they'll go to Walmart. So they're still spending money. They may be trading down in different areas, or they're trading extremely high up into like super luxury goods. But the other side of the economy, so the part of the K that's going down, is starting to feel the pressure just from inflation being stagnant right now, the job market, which appears to be weakening. I know we have the BLS labor that is delayed, but I think ADP came out with some numbers this morning, and they were expecting, and ADP is really skewed too. That number moves but for November they were expecting growth of like 40,000, 32,000, and no, they were expecting growth of 40,000, and they reported negative 32,000. So that's a big delta in there, just as to where it's at. But like I said, ADP is usually off, count on 50% of the time, maybe, I don't know. And we won't have any more government data information as far as like labor data until after the next Fed meeting. So with this state where we're seeing this weakening economy right now, with the information that we have, we don't have much inflation data. We do have the job data, which points to a weakening job market. Yeah, it looks like the Fed may be looking to cut next week.
Yeah, yeah, I did see that. I know that Chairman Powell spoke a little bit about that just yesterday, kind of in vague terms. So I'm going to take another look at that because we were talking offline that had just happened. Continuing this kind of theme of the potential of a tale of two economies in a sense, and really to an extent, I think it's fair to say, feel free to disagree with me, but there's always a tale of two economies when you're talking about Main Street and Wall Street, with regard to especially, the inequality gap that we continue to be concerned about that's been ongoing for quite some time. That's certainly not an anomaly of, a current presidential administration or anything, but whether or not it's getting worse is another matter. So in terms of bridging the gap between positive market metrics and what some are categorizing as negative consumer sentiment, with regard to market volatility in that context, what do you see in terms of just the market behavior, stock pullback versus any kind of adjustments in the long-term bull market? Are we seeing crash or recession signals in your opinion?
No, not yet. Not necessarily crash or recession signals. We just had like a 5% pullback, so that's not even a full correction, right? Like
Okay.
you need a 10% pullback from your highs, pretty much, to be somewhere in correction territory. So we had like a 5% from pullback last month, but the month actually ended positive for stocks, right? It eked
Okay.
out positive gains on Friday for most of the indexes, and the small caps continue to like dominate. As far as returns goes, here in the last few months, people haven't really paid attention to it. They're usually paying attention to the Mag 7 and the big large cap companies. AI, I know you were speaking about that and whether that's a bubble. AI is it's an interesting thing. We're going into 2026, where it's a point where coming up, I think yesterday or earlier this week was like the 3-year anniversary of Chat GTP coming out.
3 years already? Wow.
Yeah, or OpenAI. One of those
Can't
big
believe
AI
it.
companies just came out like 3 years ago. But
Yeah.
we're in a stage where you've been throwing capital expenditures into these companies next year. People want to see returns on that investment. How is AI impacting the returns? That's something people are looking for as far as with the AI right now. So if you're looking at the bubble itself, you have to look at and see, can these companies that are spending all this money afford to spend all this money? Most of them that are like the large companies, they have capex to spend. And then how are they spending the money? You look at a company like Oracle, which has a lot of people worried right now. I don't know, worried might not be the proper word, but it brought the AI thing to light when they started doing the credit default swaps, where they were essentially loaning out money or issuing bonds, issuing loans against their assets versus sending out the equities. So taking a debt position versus pledging equities, whereas the equities, the stocks, they could pledge stocks could go up 20, 30%. Whereas the debt, they could be set at say 5, 6% to pay that back. So that gap in between there is why companies do it in debt. I mean, that's just business, that's just economics. Most companies fund things in debt. But you have to make sure that all this debt isn't funded in overextended and then in a circular nature, like where is the money coming back to? Does all that makes sense? I know I just said a lot inside of there.
Yeah, that's certainly high level stuff for but I'm glad that you're explaining that, because that's the purpose of this show is and as I said, I'm providing a space. I'm inviting folks like you, the knowledge experts, on to teach me as much as those listening. So for someone like myself, so for the average person on the street, just watching their portfolios, what does what you just described mean for them? What should they be looking at? Do they need to look at like price to earnings, or how much cash these companies are holding versus? I mean, can you dive into that just a little bit more?
Right. So if you're a person who has like a okay, and you're investing inside that, you just want to make sure you're staying invested inside that. Go in there, check the allocations, because long term it's all going to work out. Those funds are usually inside 401ks, are going to be inside the indexes, correct? So they'll be inside the indexes and they'll kind of just even themselves out. Now, if you want to look at certain companies, like you say, you want to know what are you looking for? You say like prices to earning. Yeah. So you want to have earnings, right? You want to have earnings compared to your prices. You want your multiples not to be extremely high compared to the market. The market's multiples around, I believe, 23, which is considered historically high, or but it's a different market. That's what you have to understand as well. Like people talk about historical things with stock markets. This technology that we see, while all technology is revolutionary, this is like really revolutionary. This is like the internet on steroids, right? So you have to look at that, and then so you can't necessarily say that this company has a really high PE ratio, price to earning, because it could grow into that multiple really fast or really slow. These companies like Nvidia, just like last year, a couple years ago, it was extremely expensive, but as the stock price goes up and their earnings go up, it actually gets cheaper to buy. So you just want to make sure that companies are not that the way they're spending the money. So, like you said, a simple way to look at it, you want to look at sure to make that they still have margins. They still have, when they report at the end, you want to listen to what they're saying about how they're spending their capital, how much they're spending on AI, what they're looking to see in return for that AI, and just if they see a slowdown in demand. A lot of that, what you need to see on this side is just listen for the orders, demand, and if those orders can actually be fulfilled.
Thank you. Yeah, that's very informative and good to know. All right, let's move on to my next questions. Um, Consumer strain. There's been a chatter in the mainstream media and some in financial services industry that the average family is feeling pinched despite record corporate profits and high S&P 500 levels. So, what indicators present evidence of a pinched feeling? First of all, do you agree that that's happening? Is that a accurate characterization?
Yeah, the average Americans are feeling the pinch. So we haven't had any inflation data right here lately, but you can go out and look and see if prices are higher and prices have grown. You know,
Mm-hmm.
earlier you just look back and think about how inflation works in general, right? So we look at inflation and just adding on whatever the percentage is from the prior month, the prior year, right? But the prices of the total inflation is already still there. So when we had inflation that was and prices went up like 10%, we had like 10% inflation
Mm-hmm.
in the Biden administration. Those prices went up that high, but those prices like stay there, right? So even if inflation goes down, those prices stay the same, but they didn't increase as much. So you're already sitting at a higher price. Uh, Savings levels will start to come down for American households because they're just spending right now in the holiday season, which is a diversion because you hear people are crunch, people are worried, the sentiment, like we're saying that we're worried as consumers. But then when you look at the data from like credit cards, you listen to the Cyber Monday and the Black Friday stuff that just happened, people are spending at record levels. So there's a divergence in what people are saying and what people are actually doing. And then as far as uh, GDP's been growing, so GDP has grown in the second quarter. It's still outpacing or right there with inflation. So purchasing pricing has still is still strong. It's the labor market. If people don't have jobs, they won't be able to spend. That's the thing. It's the holidays. People want to buy their kids stuff for Christmas and or whatever holiday it is you celebrate.
Yeah, exactly. Yeah, for sure. I mean, that kind of speaks to what's, I guess, also been an ongoing debate and conversation about the growing gap, perhaps, between spending power of the average family versus, how the market's doing. Not necessarily, and GDP is not necessarily. It doesn't measure a lot of things that we consider to bring us well-being in our lives or a feeling of security. It's not a perfect indicator for sure.
Right? People too often confuse the stock market as the economy, and they're not the same.
Exactly. Yeah, for sure. And I think about the current, and this might be fun to just do, a total different segment on. I've been curious lately about how the market's impact on real lives, people on Main Street, is different than maybe past decades where I'm going to take a guess at this, but I would assume that with the information age much more access to everything from apps to just googling something about finding out about how to invest in the market. The access to investing seems to be much more wide open than it used to be in past eras, and I would think that would have encouraged many more people and a wider demographic, age wise and otherwise, to participate in the market in a variety of ways. I mean, we even have the crypto revolution. Would you agree that maybe some of that is helping a bull market continue as well, just the simple volume of participation of individuals, or no?
Yes, so the democratization of information has definitely increased trading.
Great way to put it.
I think one thing we just learned is that crypto does matter in the stock market. Like we saw Bitcoin from its October high, like crash and run. And stock market, that's when it was, bumping and moving as well. It's not necessarily exactly correlated with it, but it definitely has an influx with it because there are only so many, there are a finite amount of dollars in the world, right? So they're taking that money from somewhere and spending it somewhere. What we saw in the stock market last time was a rotation. Last month, what we've been seeing is, I think it's healthy. Like you asked earlier about volatility.
Mm-hmm.
Low volatility is healthy. We saw it rotating out of the large stocks, large cap stocks, into other large cap stocks, but not necessarily so heavily concentrated in those big 10 that we've seen all year leading the way. And it's still being diversified outside into international markets as well as the dollar continues to weaken. So people are looking to invest in multinational companies as well.
How it all right, so moving on, my next question is, to what extent could policy decisions, changes, expansions, even those dating back to the Obama administration and expanded during that time to some extent, or made permanent by Congress during the Trump administrations, challenge the notion that inflation is a primary concern of small businesses? So the topic here is and the essential question is inflation a primary concern of small business? And I kind of prefaced with that context because, and I'll just give a little bit of information here prior. During the Obama administration, we had the qualified small business stock incentive was passed, and then it was expanded during the Trump administration by Congress in OBA, or the One Big Beautiful Bill Act, as it's known. And then we also Congress extended the permanency of the Tax and Jobs Act of 2017. I always say that backwards. We also have things coming up that are going to apply or continue to apply with the QBI, or qualified business income incentives. So there are incentives out there for small business, is essentially what I'm getting at, in recent legislation as well as past legislation that was expanded. So how does that weigh against what inflation may be doing for small business concerns or activity?
Right. So yeah, those benefits they'll kick in. Like another one is the accelerated bonus appreciation, where they could bonus up to like 100% of things. But we haven't really seen a lot of that happening yet. People are still waiting to see how those things are going to roll out into 26, how they're going to affect them. But like some of these things they could be doing right now, right? Taking that accelerated bonus appreciation, things that the qualified business income, things of that nature. Inflationary, like small businesses, yeah, they can't handle inflation or price changes or tariffs as well as large corporations. They just don't have the balance sheets, right? So some things that small businesses may do it, and this is how people, while rate cuts matter sometimes and rate cuts don't matter sometimes, a small business may not hire that person during the extra person during the holiday season. They might just say, that business owner might just come in and say, I'm going to have to work longer and I'm going to have to do more of a job this time, increase productivity inside his business. But overall, by not hiring that other person, decreasing productivity for or capital that could be spent into the economy, right? Because that person doesn't have a job. Remember, you have to have jobs to have money. People have to have jobs. Unemployment gets out of control. That's where it all really goes crazy. And they also may say, okay, maybe I won't carry this SKU in this product this year, right? I'll cut that back. One of the things that really jumped out with the ADP report is that a lot of the job loss that people were seeing were in small companies, like 50 employees and under, right? So that's really makes up like 35-40% of jobs in the country. So when small businesses start to feel the pinch of inflation, they don't run to the White House, or maybe they'll go speak to their local representatives and say, hey, I'm feeling this pinch, but they don't have the same voice as large corporations. They don't have the same balance sheet as large corporations, so they have to navigate it differently. Like I said, and then their local community, because most small businesses operate inside the local community, right? They don't want to increase taxes on the local community, or not taxes, or increase prices on the local community, which is like a tax to the local community, but they don't want to make their consumer pay more. So they're trying to figure out ways. Small business owners are really creative in ways to save. They've been doing it for a while. So inflation, they will feel it first, or they'll feel it most, but we'll navigate it as well.
Yeah, that's a good point, Marcus, about again getting back to kind of what we talked about earlier with sort of the gap between, that the market's not necessarily an indicator of prosperity for people on Main Street when jobs are at risk. And you're also dumping into the unemployment line a lot of people from the nonprofit sector, federal workers, in addition to those who were already looking for work. That creates a condition where the spending power of the average American, and their well being, for them and their family, there may be a divide that's continuing to grow as long as that condition remains, despite whatever market returns there are. All right, let's see, what have we got? All right, we're going to pivot now. I want to talk a little bit about the Fed in particular. Will or will there not be a rate cut? I know I think you mentioned earlier in the show that you thought there would be another cut. Fed Chair Jerome Powell recently stated that he prefers to rely on, and we're going to go back to employment a little bit with this question too, U3 employment numbers. So I'll come back to your thoughts on that because I am curious about it. But just in general, what do you think about what's happening with the potential for another rate cut?
Yeah, so since the last time we spoke, right, rate cuts, like right at the top, the last time we spoke last month, rate cuts were priced in for December. I think they were
Mm-hmm.
priced pretty high, like 75, 90%. Later, or well, we're in December now. So in November, rate cut odds went down. Some of them went down where they didn't expect us to have a rate cut just because of the data that came in, the lack of data, just what people were reporting. There was a lot of hawkish Fed talk coming out, a lot of Fed governors coming out, which is another issue that, not to get partisan or bipartisan inside of it, just where how much should the Fed governors speak when they're not in session, right? How much do they control the markets? Because that was kind of making the odds of whether a rate cut was coming, or whether a rate cut would not happen, move in the markets, right? The projected markets, and you could see it in the 10-year Treasury bond, like Treasury markets. That 10-year bond has stayed right around 4% here lately. It started like 4.8 earlier this year, but now it's right about 4%. Like at the beginning of the year, so pretty much a year ago. So they don't really have inflation data. What they have is jobs data, and they know that if this job market just like cracks or falters, it's going to be hard to get it back on track. You have to have jobs. So based on the information they have, and they won't get more new data until after their meeting, I could see that they would cut another 25 basis points.
So you do expect that to happen.
I
Okay.
do. Unless something changes in between today and next week. Like just based on the data we heard today, yeah, the employment market is starting to feel the pinch. And people can go to the stores and know kind of what inflation feels like, right?
Sure, sure. Yeah. In fact, I mean, we haven't talked about tariffs much in this episode, whereas we have more in past episodes. And folks, please, check out previous episodes on my YouTube channel, Policy for Normal People, under my name, Christy Amada. But I did see this morning where Costco sued the administration over the tariffs because of the effects it was having, and their belief that, as I know other companies think too, that the actions of the administration were illegal in terms of how they're enacting the tariffs. And again, we don't get into the politics of any of that on this show. That's not the purpose of this show. But I did happen to see where clearly big companies, even like Costco, are concerned about inflation as well, and the cost to their businesses at the border that are going to push up what they have to charge. Ultimately, it always gets passed back to the consumer. So it's kind of happening at every level, I would say. Okay, so employment, and you gave us a good segue. Again, this is at top of mind in pretty much everything we're talking about with the market, because people spending power helps businesses propel forward and do well. Everything is a circular economy, if you will, in terms of the domino effect one way or the other. I recently heard that, maybe I read, I don't remember where I heard the quote or saw it, but that Chairman Powell prefers to pay more attention to U3 employment numbers. And I was hoping you could talk to us, educate us a little bit about the differences in those numbers with just a little bit of time we have left. There are 6 categories for our listeners and viewers out there of how the labor force is categorized in terms of what type of labor we're talking about. So, can you tell us a little bit more, Marcus, about why you think he pays more attention to a U3 number?
I think so. Yeah, U3, U6. I think are the numbers you're talking about. U6 is like what U6 is the number for like the underemployed, where you're totaling and you get the total number of unemployed people. U3 is kind of what Powell likes to look at, which shows it shows people who are currently unemployed, people who are actively seeking employment. Right. So within the last maybe 4 weeks, you have to be actively looking for a job in that survey, and it also doesn't account for people who are underemployed, right? So people who are like classically trained doctors, or if you're trained to be a neurosurgeon and you're working as a barista, that type of stuff. Nothing wrong with that. That's what you want to do, but economically, it doesn't make sense as far as what. So U3, they're kind of measuring out. I think that's also more of like a global number.
Mm-hmm.
Globally, people look at the U3 number.
Yeah, that's my understanding too. It's the total unemployed as a percentage of the labor force. Yeah.
Globally, right? U3, right? Like other countries look at the U6 as in the total number. So that number is going to be like the U6 is always going to be higher than the U3 because it adds in people who aren't seeking employment, people who have become frustrated, like people who have been interviewing for jobs for have 5, 6 rounds of interviews with a job, didn't get the job, and they just say, I just need 2, 3 months off from this job seeking market. People who are underemployed, those people are included in that survey. So it increases that number a lot as well. So the
And
U3
that, just to
versus
clarify again, that's you're referring to which category?
U6 is the total one, the one I'm referring to, and PAL usually operates with U3. So
I got curious in my research when I was kind of just preparing for our conversation, wondering what the effect would be on the participation rate in the survey. So the current population survey, I think, is what's used. Correct me if I'm wrong, to come up with these categories of labor force numbers, right? And I found that over time, there's been a decline from about an 80 to 90% response rate in that survey of households to about 60 to 70%. Any thoughts just in general on how that can maybe skew the facts of the reporting for the BLS numbers?
well, I mean, so from like a stats uh, standpoint, they're sending it out to a large percentage of the population. Not percentage of the population, but for like a survey for you to have like reliable data,
Mm-hmm.
they're getting a large population set to get that number from. Obviously, you want 80, 90% population participation in these surveys, but as it goes down, yeah, so it'll probably make the numbers less accurate. If you have more nominally less accurate, if you have people who are not responding at all, you're getting a smaller demographic responding to your surveys. But the unemployment, like I said, is sent out to different people, different times, and it's a moving metric. The range. I know I've said before, look at that range, the percentage range, 4%, 4.5%. We've been in that range. Not even so much as the numbers, is the range. But yeah, we definitely need to work with our government data, getting more people to participate. I'm not sure why. That may be part of your question too. I'm not sure why the participation rates have gone down. I don't know.
Yeah, and I didn't see any theory about why. I just had come up with a across a number that changed from within the last like 20 to 30 years. There's been a decline, and I wonder sometimes if just I don't think I've ever been surveyed. For instance, have you ever been sent a survey?
No, but I was gonna say, and that may be generational, right? Like that is probably the same thing with like the census. I don't know. I haven't looked at the census to like correlate that, but
Yeah.
people probably participate. Like different generations took more into doing those type of things, filling out that stuff. Paper. The
Yeah,
one thing.
I think you're right. And I think ironically, the more access that everyone has to everyone else and their information. I mean, I know I don't answer a phone unless it's somebody in my contacts. I'll call you back, but I don't want to be scammed, because once you
Mhm.
answer one of those, then they do robocalls constantly. And so I think people are, I think it would be fair to say, I mean, without looking at any research on this, but I'm sure it's out there. And I'd be interested to hear from anyone who knows about it. Leave it in the comments. But I'm curious whether the people are just so reluctant to respond today in a way that they might not have been in the past because they're worried about anything from scams to just being harassed constantly, or and we all have a short attention span. If it's a long survey, people don't want to do it anymore. If it's more than 3 questions survey, and I'm not going to say I'm not guilty, because I am. It's got to be very quick. So I just have a curiosity about how much that might be affecting the participation rate. But it's an unanswered question for right now, at least on this show. All right, well, so we're gonna come to a wrap up. It's been a great session, Marcus. I always enjoy learning things from you, and being able to push that out and share it with other people. As I said, folks, we'll have this on the YouTube channel posted, and in mine and Marcus's social media. So please think about subscribing to my YouTube channel, and also, Marcus, you have a YouTube channel as well, correct?
Do, and don't think about subscribing. Go ahead and subscribe. It's fine. To Christy's,
Yeah, yeah.
go ahead and subscribe to both of our channels.
Exactly. Yeah, and you can find us both on LinkedIn as well. So please do that. So last question is kind of just general. Any thoughts? Any general advice on what people should be doing? Should they just kind of sit and watch? Let the new year ring in, and see what before they make any significant changes? I know we always talk about diversification. Do you have any general advice about portfolio watches?
Yeah, so I think what we just saw towards the end of this year was a lot of people becoming more diversified inside their portfolios. A lot of tax loss harvesting happening right now, where people are selling stocks that are losing position for them, or they may have tax bills on the other side to try to offset that. So you'll see that type of stuff at the end of the year. I wouldn't go into my personal positions making any drastic moves right now. Maybe wait till the beginning of next year and do a rebalance of some sort. As far as that goes, a thing I do want to mention for folks to think about going into next year. Yesterday was Giving Tuesday to date this time, and Michael Dell and his wife announced that they were going to pledge like $6 billion to all these kids' babies accounts, children 10 and under. So it coincides with the Trump baby accounts. Yeah, comes out to like $250 a kid. So that's something that everyone needs to be thinking about next year if you have children or something like that. It's like we're shifting towards where these baby accounts are going to come into effect, and there's a push for private individuals to fund these things as well. Like the Dell Corporation, I guarantee you they won't be the last one coming out to making some type of commitment like that, to where we're going to put this money into this pool going to these accounts. So that'll boost the stock market as well, like, because these people
Significant.
are buying investment funds, right? Yeah, that's
That's
what they're doing.
significant. Yeah. Yeah. I mean, again, true to the nature of this show, we're not going to get into any politics about things. We know there's been cuts in other places, but to the extent that we can see the landing of impact on pretty much everything we've talked about in the last few months since we started this show. And to be fair, folks, we haven't done a whole year. What would be interesting to see how next year looks too. But Marcus and I have been doing this since August. I think we started this
Wow.
segment. But that said, I mean, I really feel, and I interested in what you think too, Marcus. I feel like this year has been kind of a let's wait and see year, because there's so much shift and change going on from a policy standpoint, from market activity that it is adjusting and reacting and trying to figure out where it wants to live within the context of that change. That for everybody, whether it's business or us folks on Main Street and our families, just kind of watch, wait, and listen, right?
Yeah, well, I mean, it's been a year of drastic shifts, right? There's been a lot of momentum. If you just think back to where we were in February when we came out with the tariff charts, to the April lows, to where we shot up to 6 months later, to where we are kind of right now, where everything's just kind of set and resetting. Uh, yeah, this is definitely going to be a year for the annals in history. People look back at 2025 just to see, how's this going to play out? The first year of Trump's new second term, that's historical. Like, people don't generally get reelected after a year in between, or a term in between. A lot of stuff that's happening with the financial economy, reinstating these tariffs at the levels that we have. So just like the economic global toxic detox, as Secretary Bessent said, it's just 2025 has been a fascinating year for markets. Fortunately, for a lot of people, have lost a lot of money like this year, so that hurts. But there are a lot of people who made a lot of money as well. Stay invested and you really haven't lost any money yet.
Good advice. Thanks very much. Folks, that brings our episode 4 of the monthly market update with Marcus to a close. We are not going to be recording in December, so we will see you back here January, and we will do a 2-month, kind of year changeover discussion. Again, this show is brought to you by my consulting firm, Amada Development Services, LLC. Love it also if you would go to Marcus's the ABC Squared for any additional questions. If you are looking for a financial advisor, I highly recommend Marcus. As you can tell from these episodes, he's very well informed and he has your Main Street interest in mind first. So, Marcus, thanks so much for joining me again for an exciting episode, and I look forward to talking with you in the new year.
Excellent. Thanks for having me on again, Chrissy. I always enjoy it. Thank you.
Absolutely. See you later.
See you
Bye
later.
bye.